Yes, so when talk about what refer as a lease generally is that particular contract whereby the owner of the asset will convey, or in other terms will give the right to use an asset to another party for a specific period of time, and that party who has been given the right to use the asset, then he is expected to pay some periodical payment to the owner of the asset, which are called the minimum lease rentals. Basically, what that means is that I may be owning an asset and I convey or basically give you the right to use that particular asset for a specific period of time. And in that case, automatically you have to pay me because you're using my what? My asset. So that contract then is what referred as what? A lease. And in a lease, generally, there are two parties. There are two parties in a lease. So we have the first party in a lease who is called the lessor, and basically the lessor, this is the owner of the asset. So if I'm the owner of the asset, then in that case I'm known as the lessor, or basically the lessor, and this is the person who will convey, who will give the rights to another party to use that particular asset for a specific period of time. And then we have the other party who is called the lessee, and basically the lessee, this is the party who has been given the right, to use the asset, for a specific period of time, and basically this is the party who is expected to pay some periodical payment for using that particular asset. So therefore, it is important to note that in a lease generally we have those two parties: the owner of the asset, who is known as the lessor, and actually the person who has been given the right to use that particular asset and who we are saying is expected to pay some periodical payment, and that party is called who? The lessee. Now, in terms of how the leases are accounted for by these two parties, that is governed by International Financial Reporting Standard number 16, of which basically this is a new standard. And this is a new standard which was issued to replace the old standard on leases, that is IAS 17. Previously, leases were accounted for in accordance with the International Accounting Standard number 17. But basically, I'm saying that this particular standard has been superseded by IFRS 16. Superseded means that it has been replaced by IFRS 16. The reason why it is important for me to mention this is because if you check on some questions from I think or basically if you go to the past papers, you'll be able to see some questions on leases, and basically they are quoting IAS 17. So currently leases are not accounted for in accordance with the International Accounting Standard number 17, but currently we account for the leases in accordance with what? In accordance with the IFRS IFRS 16. So I want us we look on basically a very or basically an overview of how these two parties account for the leases. Okay, before we look on how these two parties account for the leases, it is important for us to maybe mention something to do with the types of leases. And basically for accounting purpose, leases are generally classified into three categories. So number one, we have what referred as the capital. This is also known as the finance lease. Is also known as the finance lease. And then number two, we have the operating lease. Lease. And number three, we have something called the short-term lease. The short-term lease. So what do we mean by a finance lease? A finance lease, this is actually defined to be a lease which transfers substantially all the risk and rewards associated with the asset to the person who is called the lessee. So is that particular lease which transfers substantially all the risks and rewards associated with the asset to the lessee, to the lessee. For example, in this case, if you come across a question and you are told that maybe company X leased out an asset maybe to company Y, and this particular company here, which is now the lessee, is the one which has the responsibility of ensuring that particular property, or basically that particular asset. It automatically means that the risk associated with that particular asset has been transferred to the lessee, because the lessee here is the one who has the responsibility to do what? To insure that particular asset. But there are basically a number of criteria which are given by this particular standard, which you can be able to use to determine whether a risk is a finance or basically an operating risk. But by definition, we say that a finance risk is basically that particular risk which transfers substantially all the risk and rewards associated with the asset to the lessee. On the other hand, when we talk about now the operating risk, we say that this is any other risk other than finance risk. Generally, what that means is that under the operating risk, the risk and rewards associated with the asset are not transferred to the lessee. And generally, when talk about a capital risk, usually these are those particular long-term risks, and whereby, if, for example, you own an asset, like assuming you own a building, you may lease out that particular building to a single tenant for the next 30 years. For the next 30 years, you own a building, you have leased the entire building now to a company or basically to a lessee, maybe for the next 40 or 50 years. So automatically that is a finance risk, because it means that the company which has leased that particular building, one has the responsibility of maintaining that particular building in good condition. All the repair and maintenance costs will be incurred by who? By the lessee. And also now the lessee will also have the responsibility to do what? To ensure that building. And also in most of the cases, the lessee will be having the right to sublet part of that particular premise. Automatically, that is what? That is a finance risk. But when we talk about an operating risk, in practical sense, this whereby, for example, you own a building, but you have leased that building to a number of tenants. What does that mean? It means that you are the person who collects the rent from that building. You also have the responsibility of incurring all the repair and maintenance cost. That is an operating risk. On the other hand, when we talk about a short-term risk, this basically a risk whose risk term is less than 1 year, or basically whose risk term is 1 year or less. So mean that if, for example, I own an asset, I lease that asset to you for a period of 1 year or less, automatically that is a short-term risk. So therefore, for accounting purpose, IFRS 16 classify now the risks into those three categories, categories. So how do these two parties, the owner of the asset and basically the lessee, account for the risk? So I want us to start by looking on accounting for risks. Accounting for risks by the lessee. By the lessee. Remember, in this case, we have said that we'll talk about the lessee. Basically, this is the person who has been given the right to use the asset, who has been given the right or basically conferred the right to use the asset. Now, according to IFRS 16, the lessee here, one, is basically prohibited from classifying the risk as an operating all finance risk. So what does that mean? It basically means that the classification of the risk as an operating or finance risk, it only applies to the owner of the asset. It only applies to the owner of the asset. So the person who has leased the asset, if you lease an asset, you should not classify the risk as an operating or finance. And actually, this is one of the main reasons as to why international accounting standard number 17 was scrapped, because generally this particular standard here had given the lessee the option to classify the risk as operating or finance. So what most of the companies were doing under this particular standard, they were opting to account for all this as operating risks, because an operating risk, what a company will account for, is generally the company is paying as the rent is the company is paying as an expense. But if a company accounts for risk as a finance risk, the company has to show an obligation of the rent which the company will pay. For example, if there is an asset to you for the next 40 years, it's basically like a loan which you have taken from the bank. So you have now to show the obligation which you have in your statement of financial position to pay me rent for the next 40 years. So what most of the companies were doing, they were avoiding classifying the leases as finance leases, because companies were trying to avoid showing that liability in their statement of financial position. And actually, that is one of the shortcomings of which was associated with this particular standard. That's why it was scrapped and basically replaced by IFRS 16, which you are saying now it prohibits the lessee from classifying the lease as an operating or a finance lease. So mean that once now a company leases an asset, or if, for example, I own an asset, I lease it to you, you are the lessee. At the inception date of the lease, that is when the lease commences, you need to recognize two items in your books of accounts. You need to recognize something known as the right of use asset, asset, and number two, you need to recognize something called a lease liability. You need to recognize something called a lease liability. So you need to recognize these two items, the lease liability and the right of use asset. So how are these two items, or how do we measure the value of lease liability? How do we measure the right of use asset? Now, the lease liability, this is equal to the present value of the minimum lease rentals. Minimum lease rentals is basically if you have leased an asset, there is the rent which you need to be paying maybe on annual basis. That is now what is known as the minimum lease rentals. So this is equal to the present value of the minimum lease rentals not paid at inception date of the lease. Not paid at inception date of the lease. Not paid at the inception date of the lease. So basically, when we talk about the inception date of the lease, we are talking of the date when the lease commenced. If, for example, like maybe assuming you are told a company is an asset for 4 years, and that company is required to pay a rent of 100,000, and this rent is payable in advance. Is payable at the start of each year. Is payable at the start of each year. So basically, how do we determine now the lease liability? We are saying that this will be equal to the present value of the minimum lease rentals. This is now the minimum lease rentals not paid at the inception date of the lease. So what that means is that in determining the lease liability, we have to get the present value of these minimum lease rentals, excluding the amount which was paid at the inception date of the lease. So in other terms, we discount this. But we don't include the amount which was paid at the inception date of the lease. That's why we are talking of a present value of the minimum lease rentals which was not paid at the inception date of the lease. That's basically how we determine that lease liability. And because now this represents what our company is expected to pay in the next 4 years, then that one we have to amortize it. We have to do what? To amortize it. We prepare something called the lease amortization schedule, and then we do what? We amortize it. Then from there we have something called the right of use asset. Right of use asset. So how do we determine the right of use asset? So the right of use asset, this one is determined by adding 3 items. One, we take the lease liability. As determined here as the present value of the minimum lease rentals not paid at the inception date of the lease. So the lease liability, and this is at the inception date of the lease. Inception date of the lease. Remember, I've said inception date of the lease. Here we are talking of the date when the lease commenced. So to this we add the payment made at or before the commencement date of the lease. Commencement date of the lease. commencement date of the lease. So when talk about the payment made at or before the commencement date of the lease, for example, in our case, we are referring to this amount. If the rent is payable in advance, at the start of the year, then this particular amount is now what we refer as a payment made at or before the commencement date of the lease. And then to this, we add the initial direct cost associated with the lease. And a good example of this is the legal cost. If, for example, today you are leasing an asset, once you enter into an agreement with the owner of the asset, then you must have a lease agreement in place. So automatically for that lease agreement to be drafted, you have to go to a lawyer's office, and that's where the lease agreement will be drafted. Automatically, the lawyer will charge you some fee. So that fee you are charged when the lease agreement is drafted, we refer to it as the initial direct cost associated with what? With the lease. So whatever you get here is now what you refer as the right of use asset. And once this particular right of use asset has been determined, because it will be recognized as an asset in the books of account of the lessee, then the lessee should depreciate this. Because it's an asset. And actually, this should be depreciated on a straight line basis, at the shorter of two periods. At the shorter of number one, the lease term. The lease term, we are referring to what? We're referring to the period of the lease. So if the lease is for 4 years, if the lease is for 5 years, that is now what we refer as the lease what? Term. Like in our case here, the lease term are 4 years. So we take the shorter of this, or Roman 2, the economic life of the asset. So if the examiner has given you those two values, the lease term and also the economic life of the asset, then you take the figure which is shorter. And then to compute the depreciation per annum, you're going to take now this value which you have there, the rate of use asset, and then you depreciate it on a straight line basis. So what you'll get now the amount of depreciation which the lessee will recognize as what? As an expense in the income statement. So therefore, as far as the accounting of leases by the lessee is concerned, we are saying number one, the lessee do not have that option at the IFRS 16 to classify the lease as an operating or what? Finance. We have said at the inception date of the lease, that is when the lease commences, the lessee is required to recognize two items in his books of account. The lease liability, we have looked on how we measure that, and the right of use what? Asset. We have also looked on how we determine that. But there are two exemptions. As far as this is concerned, meaning that there are some instances whereby, for example, you can release an asset, but you should not go ahead and you recognize the lease liability and the rights of use asset. Now, which are those two exemptions? Number one, the first exemption is in case of what you refer as the we are talking of the exemptions. Number one is in case of what you refer as the short-term risk. So basically what that means is that if you lease an asset for a period of 1 year or less, that is automatically a short-term risk. So in that case, IFRS 16 does not require you to recognize the right of use asset and there is liability. And there is what? Liability. In that case, what you can recognize in your books of account or basically in your financial statement is the rent which you paid. If, for example, you lease like an asset for a period of 6 months, a period of 1 year, you paid a rent of 100,000, a rent of 200,000. So you recognize that purely as an expense. You don't have to recognize the right of use asset, and there is what? Liability. Number two, or the other exemption, is whereby the leased asset is of raw value. So you have leased an asset which is of raw value. For example, the asset which you have leased here is something like a personal computer, maybe something like a laptop, having a value of 40,000, having a value of 50,000. So you don't have to recognize these two items. The right of use asset, there is what? Liability. So what you just need to recognize in your financial statement is basically the rent which you are paying. The rent which you are paying. So therefore, we have those two exemptions as far as the accounting for leases by the person who is called the lessee is what is concerned. And I think with that quick recap, basically we can be able to look on an illustration question regarding how the person who is called the lessee account now for the leases in his books of accounts. And I want us to look on an illustration or basically a question. We have a question here which was tested in which sitting. This is sitting for August 2022. August 2022, question number 4A. August 2022. Question 4A. Question 4A. So you go to that particular question there. You go to that particular question. So once you get the question, just confirm so that we can be able to move together. Once you get that question, just confirm so that we can be able to move together. In the chat box, you can just write yes. You already have the question with you. Yes, so once you get the question, let me know so that we can be able to move together. Okay, so let's go through it. We see what the examiner was requiring. So the question reads, on 1st January 2019, 𝗏𝗏 Limited entered into a lease into a contract to lease an item of plant and equipment from a supplier for 3 years period. The terms of the lease were that 𝗏𝗏 Limited was to pay shillings 500,000 each year, with the payment commencing on 31st of December 2019. Initial direct costs incurred on the lease amounted to shillings 30,000 and were paid by 𝗏𝗏 Limited. The plant and equipment had a remaining economic useful life for 5 years at the inception date of the lease. The lease contract did not contain any purchase option for the lessee. So 𝗏𝗏 Limited can borrow at the rate of 10% a year. So what are we required to do? We are required to analyze the accounting treatment of the above three transactions from the inception to the inception and for the 3 years period of the lease. So basically, here we are told that if we go back to the first paragraph here, we are told on 1st of January 2019, 𝗏𝗏 Limited entered into a contract to lease an item of plant and equipment from a supplier. So basically what that means is that this company, which is called 𝗏𝗏 Limited, this is the company which leased the asset from the supplier. So who is the owner of that asset? The owner of the asset in this case is the supplier. And remember, in this case, we have said that the owner of the asset is called the lessor. Lessor is the owner of the asset. Lessor is the owner of the asset. And the person who has leased the asset, like in this case, 𝗏𝗏 Limited, is the lessee. And remember, in this case, what you have said is that according to IFRS 16, the lessee here should not basically classify that this as operating all finance. What you have said you need to do is to recognize two items, that is liability and the right of use asset, unless or except in two instances, whereby number one, the risk is a short-term risk. And actually, if you check on the information which is provided here, this is not a short-term risk because we are told this is a risk for 3 years. It's a risk for 3 years. And number two, we have said that the asset which has been leased is an asset of raw value. So basically here we're not given the value of the asset, but basically take into account this a risk of 3 years, then automatically this cannot be, or basically now the receipt that is Breakwood Limited automatically will be required to do what? To recognize the two items, there is liability and the right of use asset. So always, once you come across that question, the first thing you need to do is to determine the risk liability. That is the first thing which you should determine. There is liability, risk liability, and after determining this risk liability, then later on you'll have to determine what you refer as the right of use asset, the right of use asset. So, and we determine this particular risk liability at the inception date of the risk. So someone is asking a question here: should those exemptions be met, or are they dependent? Now, did I understand that question, Eva? Should those what exemptions be met to? Oh, are they supposed to be met together? No. They are not supposed to be met together, because, like in this case, here you can see we only, I think, given one of the, or basically here we told that take into account you're told this that is for 3 years. Automatically, basically that means that this cannot be a short-term risk. This cannot be a short-term risk. So therefore, but in case basically the risks do not qualify to be accounted for in accordance with IFRS 16, whereby, for example, the receiver will not be required to recognize the right of use asset and the risk liability, mostly will be told that, for example, these are short-term risk and something like that. But automatically these risks then qualifies to be accounted for in accordance with IFRS 16. So the Breakwood Limited need to recognize the right of use asset and what if there is what? There is liability. So we always have to start by getting the risk liability, because I hope you can remember you have said that for you to compute the right of use asset, you need to have this value here. So, and also we determine this value here at the inception date of the risk. The inception date of the risk is the date when the risk commenced. So if you check on the information which are provided with, we are told that this particular risk commenced on 1st of January 2019. That is now what we refer as the inception date of the risk. And actually you have said the risk liability, this is equal to the present value of the minimum risk rentals, minimum risk rentals not paid at inception date of the risk, not paid at inception date of the risk, not paid at the inception date of the risk. So we discount the minimum risk rentals, excluding the amount which was paid at the inception date of the risk. Now, what you're told in sentence 2 of first paragraph, you're told that the term of the risk was that Breakwood Limited was to pay 500,000 each year, with the payment commencing on 31st of December 2019. That is very, very important, that Breakwood Limited leased an asset, and this company is supposed to pay a rent of 500,000, and the first rent will be paid on 31st of December 2019. What does that mean? It means that this rent is payable at the end of the year. Is payable at the end of what? Of the year. That is very, very important. You may come across another question, whereby the risk is payable at the start. Is payable at the start. If time allows, maybe we're going to look on. We're going to see whether we're going to get another question whereby the lease is payable at the start. And also, we are told that this lease is for how many years? In the first paragraph, sentence 1, we are told that this is a lease for 3 years. So this is a lease for 3 years. And the rent, which is payable here, is 500,000. And basically, the first payment will be paid at the end of the first year. At the end of the first year. That is on 31st of December 2019. So therefore, can we determine this? So we are saying it is the present value of the minimum lease rentals. These are minimum lease rentals, not paid at the inception date of the lease. So in our case here, you can see we don't have any amount which was paid at the inception date of the lease. So basically, what we need to do is to discount this. So we take 500,000, and actually for discounting purpose, you can see that these are annuities. These are annuities. So what we need to do is to multiply this with the present value interest factor, 𝗙𝗏, for how many years? For 3 years. And when discounting this, the examiner will give you something called the 𝗓𝐶 borrowing rate, or you can be given something called the interest rate implicit in the lease. Implicit in the lease. So the examiner can give you any of this. The 𝗓𝐶 borrowing interest rate, or the interest rate implicit in the lease. If you check on the information which you are given here, actually in the last paragraph, we are told Breakwood Limited can borrow at the rate of 10%. So we are given now the 𝗓𝐶 borrowing interest rate. So therefore, what we need to do, we need to multiply that with the present value interest factor for 3 years at the rate of 10%. At the rate of 10%. So in this case, you have to remember the formula for getting that present value interest factor of annuity, because in AFR, you may not be given the table by the examiner. So the formula for getting this is 1 minus 1 plus R. Our R, remember, is 10%. So this will be 1.1. We raise that to power negative n. Our n here will be 3. And then we divide all these with R. We divide this with R, which is 0.1. So this is how we determine the present value, or basically how we determine the lease liability at the inception date of the lease. So give me that final figure here. You give me the final figure. So for those who are joining, we are revising on this topic of leases, and actually we are doing this particular question for August 2022, which is question number 4A. Yes, you can use the table provided you understand this. Provided you understand how to discount, you can use the table. You can in fact have this, but you see, take into account this is an annuity. This will be tiresome. You assume this like your cash flows 500,000, but in this case, can you see these are similar? So no need of doing this. And then you have now the present value interest factor at the rate of 10%, and then you have those figures. You can equally use that approach. You'll get the one and the same thing. One and the same thing. So remember, this is something you have done in financial management, how to get the present values. So I'm given a figure of what? I'm not getting the answers here. I'm only getting the answer from Vincent. Yes, I'm given a figure of 12, 43, 426. So basically, this is now the present value of the minimum lease rentals not paid at the inception date of the lease. Now, assuming in this case, because maybe we may not come back and do another question on this, assuming, for example, in this case, we are told that this rent, which is paid by Breakwood Limited, is payable in advance. is payable in advance. So because in this case, you can see this rent is payable in arrears at the end of the year. So mean that these are ordinary annuity. This is something you have done in FM. So assuming you're told that this amount is payable at the start of year 1, at the start of year 2, and also at the start of year 3. So what would be the difference here in terms of our discounting, in terms of getting the risk liability? Because we are saying in getting the risk liability, we get the present value of the minimum risk rentals not paid at the inception date of the risk. Like in our case, you can see this amount was paid at the inception date of the risk. So that will not form part of the liability. You see, a liability is what the company will have to pay. So the company has already paid the this particular amount here. The company has already paid the amount here. So therefore, the difference would be we take 500,000, but in our case, we will only discount that and that. Sasa? Yes, we will only discount this and this. So meaning that we have our formula, which is 1 minus 1 plus R, which remain 10%. And then what will be our N here? What will be our N here? Who can tell us? What will be our N? Our N here will be what? Our N will be 2. What will be 2? Our N will be 2. Our N will be 2 because we are only discounting that and that. Will be 2, and then divide that with what? Divide that with R. So that is the difference when you are given a rate or basically a minimum risk rentals, which is payable at the start in advance. In what? In advance. So therefore, this is now what you call as the risk liability. And basically what you have said is that because this risk liability, this represents what the company will have to pay for the next 3 years. So this is just like a loan to this company. So what do we have to do? This one, we have to amortize it. We have to amortize this. And to amortize this, before we determine the rate of use asset, let's amortize this. We amortize this by preparing something called the risk amortization schedule. There is amortization what? Schedule. There is amortization schedule. There is amortization schedule. So how do we prepare this schedule? So we will have now a column for our years. So remember, this lease is for 3 years. The first year, I hope you can remember, will end on 31st of December 2019. The other year will end on 31st of December 2020. And the other year will end on 31st of December 2021. So the other column here, we're going to have the lease liability. There is liability balance brought down. There is liability at the start of the year. Then the next column here will be for the interest. And this interest is computed based on this rate which you have used here for discounting, the receipt borrowing interest rate, which we have said can also be known as the interest rate implicit in the lease. And then here we will have the column for the cash paid by the company. And then finally, the last column here will be for the lease liability at the end of the year. The lease liability at the end of the year. So basically, that's how we arrange this particular, or how our lease amortization schedule will look like. But equally, if, for example, these lease rentals is payable at the start of the year, also when preparing your lease amortization schedule, there is also a difference. So like in this case, if our lease minimum lease rentals is payable at the start of the year, this is basically how you arrange or how your lease amortization schedule look like. Always you start with the column for years. This one will not change. And then you'll have a column for the lease liability at the start of the year. Then you will have a column for the cash paid, because rent is payable at the start. At the start. Are we together? Yes, at the start. And then you compute now the interest at the rate of 10%. And then you have the lease liability at the end of the year. Maybe I'll share a certain handout with you where we have such a question whereby the risk is payable at the start. And because I've done there is a solution for that, you'll be able to check on it. You'll see the difference. You'll see the difference. How we prepare this amortization schedule whereby the minimum risk rentals is payable at the start and also at the end. Sasa, but let's finish on this. I'll share that handout with you where there is that other illustration whereby the minimum risk rentals is payable at the start of the year. So what do we start with here? We start with the risk liability at the start of year one. And basically that is the figure which you have determined here, 1243, 426. And then we compute the interest, which will be 10% of this. And that will be 124, 343. So let's just work with that to the nearest whole number, And then how much cash was paid at the end of year one? Who can tell us from what we have here? How much cash was paid at the end of year one? At the end of year one, how much cash was paid? Who can tell us quickly? Yes, the cash which was paid at the end of year one is what we have here, 500,000. So that's the cash which was paid. So how do we determine this risk liability at the end of the year? To determine the risk liability at the end of the year, we take, remember the just like around, we take the risk liability at the start plus interest minus what was paid, minus this plus this minus that. We get the risk liability at the end of the year. That will give us a figure of how much? The risk liability at the end of year one. Risk liability at the end of year one. Yes, so give me the answer. Here we move. I'm only getting answers from CPA. Yes, so you need to participate. That's what we agreed. You participate by giving me these answers so that I know we are together. So I'm given a figure of 867, 769. So that risk liability at the end of year one would be the risk liability at the end of year two. At the start of year two. We get 10% of this as our interest, and that will be 86 to the nearest whole number, 777. So the cash which was paid at the end of year two is what we have there, 500,000. Yes, let's get the risk liability at the end of year two, which will be, we compute that using the same approach, this plus this minus that. That will give us a risk liability of how much at the end of year two? At the end of year two, I'm given a figure of 46. So that will be the opening balance here, 45, 46. We get 10% of this, which will be 45, 455. The cash which was paid at the end of year three was 500,000, this one. And then we get the risk liability here, the risk liability at the end of year three. So what is the risk liability at the end of year three here? The risk liability here is how much? Yes, this one should be 0 because what we have done, we have been able to amortize our risk liability. So basically that's how we determine the risk liability, and also we do what? We amortize it. So then number 2, we need to determine what is known as the right of use assets. Right of use assets. Right of use asset. You have to remember, we have said that to determine this right of use asset, basically we add 3 items. Number 1, we have the risk liability at the inception date of the risk. The risk liability at the inception date of the risk, and basically that is what we determined here. That is on 1st of January 2019, and that is a figure of 12 43,426. So to this, what do we add? We add any payment made at or before commencement date of the lease. So we add any payment made at or before the commencement date of the lease. So basically, this applies whereby the minimum lease rentals or the rent is payable in advance, is payable at the start of the year. For example, if this rent is payable at the start, for example, this amount was paid at the start of the first year, that's what we have here. But anytime the rent is payable in arrears at the end of each year, then you will not have this, because we don't have any payment which was made at the inception date of the lease. So in our case, this is nil. And then to this, I've said we also add the initial direct cost. Initial direct cost associated with the lease. Usually this is the legal cost. The legal cost. And I think in our question here, we're given the initial direct cost. If you go to paragraph 2, we are told the initial direct cost incurred on the lease amounted to 30,000, and which was paid by 𝗏𝗏 Limited. So we are given the initial direct cost of the lease. How much was that? That was 300,000. Sorry, that is 1,000. That is 1,000. And then whatever we get here, we refer to that as the right of use asset. The right of use asset still at the inception date of the lease. At the inception date of the lease. So this will be a figure of 1,273,000. 1,273 what? 1,000. So that is the right of use asset at the inception date of the lease. Then what you have said is that this right of use asset, because this will be recognized as an asset by the lessee, it has then to be what? To be depreciated. And actually, I've said we depreciate this at the shorter of 2 periods. At the shorter of 2 periods. At the shorter of 2 periods. Shorter of 2 periods. So number 1, I've said we take the shorter of the lease term. The lease term, and number 2, the remaining economic life. The remaining economic life of the asset. Remaining economic useful 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 life of the asset. Someone is saying, I repeat what? Samsung, you're saying, I repeat, kindly repeat the 2 formulas. Which are the 2 formulas are you talking about? Which formulas? Which formulas are those? Oh, my internet was buffering. So this is basically the formula for getting this one, PVVA. Present value interest factor of annuity. So we take annuity, and this is basically something you have already covered in financial management times this. This is how we get, okay, this is the formula generally for getting this. 1 minus 1 plus R raised to power negative N all over R. All over R. So our R here is 10%. Our N here is the lease term. This is the lease for 3 years. That's why you can see we have that here. We have that there. We have that there. But basically, you have to remember this. This is something which is covered in details in financial management in that topic for time value of money. So the assumption here is that you have done something to do with time value of money. Time value of money, because it's just an application of something you have already a concept covered in financial management. Yes. So basically, what I want us to do is we go back to the question and we check, do we have these two values here? Do we have the least term? Do we have the least term? Do we have the least term? And do we have the remaining economic useful life of the asset? So if you go back to that particular question, I think in paragraph 1, sentence 2, we are told the term of the lease, that is first paragraph, sentence 2, we are told the term of the lease. Okay, not actually sentence 2. First paragraph, sentence 1. On 1st January 2019, Breakwood Limited entered into a contract to lease an item of plant and equipment from the supplier for a 3-year period. So basically, we are given the lease term as 3 years. And then, if you go to the information we have in paragraph 2, sentence number 2, paragraph 2, sentence 2, we are told the plant and equipment had a remaining economic useful life over 5 years. Had a remaining economic useful life of 5 years or 5 years. So in our case, you can see we are given these two periods. The lease term, the remaining economic useful life of the asset. So in this case, we are saying you take the period which is shorter. The period which is shorter. Automatically, between 5 and 3 years, 3 years is the shorter period. So basically what that means is then we have to depreciate this right of use asset using a straight-line basis for a period of 3 years. So meaning that to get the depreciation per annum, we take the right of use asset, which is 1273. This should be 426. 426. We divide that with 3 years. So that will give us the depreciation per annum, which this company will recognize as an expense in the income statement. So this will give us what? This will give us what? The depreciation per annum to be recognized. To be recognized as an expense. Now the figure should be 1273 426. I think I've corrected there. 1273 426. So this will give us a figure of what? This will give us a figure of what? I'm not getting those answers. I need to get the answers. Okay, I'm given a figure for 424 475. 475 what? 475,000. So this what Breakwood Limited will recognize as an expense in the income what? Statement. Now, if you take on what the examiner is requiring, or actually if you go to the requirement, what are we required to do? Or what was the examiner requiring? So we required to analyze the accounting treatment of the above risk transaction from the inception for 3 years, from the inception and for 3 years period of the risk. So if you require now to analyze how this transaction is supposed to be what? To be accounted for, basically you analyze that by preparing financial statement extract. For example, in our case here, we need to prepare the income statement extract. We show what was the company supposed to recognize in the income statement as far as this transaction is concerned. Number 2, we prepare the statement of financial position extract. We show what was supposed to be recognized there by what? By the company. So therefore, let's do that. Let's prepare those financial statements extract, starting with the what? Starting with the income statement. Starting with the income statement extract. Income statement extract. And basically what we are required to do here is we show what the company was supposed to recognize in the income statement for the period of 3 years, 2019, 2020, and 2021. So that is on 31st of December 2019, 31st of December 2020, and 31st of December 2021. So in this case, who can tell us what was supposed to be recognized by our company in the income statement as far as this transaction is concerned? One of the items which the company was supposed to recognize in the income statement is, I'm told by CP Ividia, these interest. Anything else which was supposed to be recognized as an expense in the income statement of this company? Anything else other than that interest? Some guys are not talking to Mwalimu here. Akina Paris. Samsung, yes, you need to talk to Mwalimu here so that you know whether we are together or not. Carol, you are not talking to Mwalimu here. Yes, what should be recognized in the income statement? Yes, in the income statement, 2 items. One, this particular depreciation, and then also this interest. And these are items of expenses. So therefore, 2 items of expenses were supposed to be recognized in the income statement. We have the depreciation on right of use asset. You can just put it like that, depreciation on right of use asset. And actually we have said that this depreciation of 424,475, this one will not change for the next 3 years, because remember what you have computed here, this is the depreciation per annum, because you have said that this right of use asset will be depreciated on straight line basis for the next 3 years. Using straight line method, the depreciation per annum is the same. So the other item which the company will recognize as an expense is the interest on leases, which we have here. So in the first year, 12, that is 124, 343. Then we have 86, 777, and then we have 45, 455. Yes, so basically that what the company was supposed to recognize in the income statement. Then what about in the statement of financial position? So let's prepare the statement of financial position extract. Statement of financial position extract. And here we have equally 2 items. First of all, we have this right of use asset, and also we have this liability. But we are going to see that this liability has to be split into 2. Part of it is recognized as an uncurrent liability. Part of it is a current liability. But before you look on that, I want us to record the right of use asset. And this right of use asset is recognized as an uncurrent asset. As an uncurrent what? Asset. And basically, remember, we're also preparing these for 3 years. We are preparing these for how many years? For 3 years. For 3 years. So let's determine the right of use asset. How do we determine the right of use asset? The right of use asset, we take the amount for initial recognition, which we have here. And then remember that is the right of use asset on which date? 1st January 2019. But you're saying that that right of use asset on annual basis, it will have to be depreciated with this amount. So how do we get the net book value, or basically the right of use asset at the end of the year, at the end of the first year? We take this amount for initial recognition minus depreciation for the first year, minus depreciation for year 1, right of use asset. So what are you getting? This minus depreciation for the first year only. That will give us how much? Someone to give me that figure there. So the amount for initial recognition minus depreciation for year 1. minus depreciation for year one. What are you getting? What are you getting here? Yes, we are saying this is an asset. How do you get the net book value of an asset? How do you get the net book value of an asset? You take the cost of the asset minus depreciation. Minus depreciation. Minus depreciation. So the costs, the initial amount is 1273,426 minus depreciation for year one. So I'm given a figure of what? Is it 848,951? Yes. So then can you give me the net book value of this asset at the end of year two? So how do we get that? The net book value at the end of year two. You take this amount minus now depreciation for 2 years, because this is depreciation per annum. So you want to get the depreciation at the end of the second year. The amount for initial recognition minus depreciation for 2 years. Minus depreciation for 2 years. That will give us what? That will give us what? The value of the asset minus depreciation for 2 years. Minus depreciation for 2 years. Minus depreciation for 2 years. So that will be 4. Now, who is getting 0 here? It can't be 0. It can't be 0 because we know that this asset can only be fully depreciated at the end of the third year. At the end of the third year. So we are taking this minus depreciation for 2 years. Depreciation for 2 years. Yes. And then at the end of 2021, you take this minus depreciation for 3 years. Minus depreciation for 3 years. So that will give us what? Yes, this will give us 0. Basically, what that means is that at the end of 2021, our asset will be free depreciated. Will be free what? Depreciated. Will be free depreciated. Yes. So then from there, next, this particular liability which we have here will be recognized still in the statement of financial position as a liability. You can see that is liability. But now this one, that we have to split it. Part of it is recorded or is recognized here as a non-current liability. Part of it is recognized as a current liability. Here you have to be very keen. You have to be very keen so that you understand how we split this. So under the non-current liability here, we will have something called the risk liability, and equally under the current liability, we will have something called the risk liability. The risk liability. So first of all, you have to remember that when talk about non-current liability, these are the long-term liabilities, or in other terms, liabilities payable for a period exceeding one financial year. For a period exceeding one financial year. Current liabilities are liabilities payable within 1 year. Within one what? Year. So therefore, I need you to be very keen here so that you can understand how we get this. So in the first year here, that is at the end of 2019, there is liability at the end of year 2. There is liability at the end of year 2, this one, because is as at the end of year 1 is basically a risk payable beyond 1 year. This one in year 1 is recognized here as an non-current liability, 45, 46. So I hope you can see what I've done. I've said, okay, this should be 45, 46. So I've said at the end of year 1, to determine the amount of risk liability you're going to recognize as an non-current liability, take the risk liability at the end of year 2. And then you in year 2021, the amount you're going to recognize as a non-current liability here is the risk liability at the end of year 3. How much is it? It is 0. It is 0. And then automatically you can see at the end of year 2021, you should take now the risk liability at the end of 2022. Do we have any risk liability there? No. So that is how we determine. That is how we determine. The risk liability to be recognized as a non-current what? Liability, as a non-current liability. So there is someone who is still here in the income statement. We have moved from the income statement. We are here. The initial direct cost is not recognized as an expense. It is part of this asset here. It's not recognized. So we are here. So now then we come here. How do we determine the amount to be recognized as a risk, or how much amount of the risk liability is recognized as a current liability? Remember, current liability is basically amount payable within 1 year. Payable within one what? Year. So to determine the amount which you're going to recognize here as a current liability, you come here, and basically you get the difference between this and that. Between that and that. So this will give you the amount of risk liability you're going to recognize as a current what? Liability. The same case here, you get the difference between that and that. Whatever you get here is the amount of risk liability you're going to recognize as a current what? Liability. So first of all, can you give me this difference here? Give me that difference to determine, so that we know the amount to be recognized as what? As the current liability, as a current liability in the first year. In the first year. Yes, I'm given a figure of what here? I'm given a figure of 413, 223, 223. So that is the amount to be recognized as a current liability, the amount of risk liability to be recognized as a current liability in the first year. In the second year, we get the difference between these two. And I think it should be this one, 45, 45, 46. And then in year 3, you get the difference between this and here. So you can see we don't have any risk liability there. Automatically, that would be what? That would be 0. That would be 0. So that's basically how we split that risk liability between the amount to be recognized as an current liability and the current what? Liability. This is one of the area usually where I've seen in the past, majority of the students having a challenge to split that risk liability between non-current and also what? Current. Between non-current and also what? Current. So therefore, you should see what basically you have done there. You must be in a position to do what? To split. You must be in a position to split. So for non-current asset, we use the right of use asset, and the risk liability, we read what? We read the schedule. We read the schedule factoring. Yes. So that's basically what we do. Whatever I've explained here. The right of use asset is a non-current asset. The risk liability is a liability, but equally we are saying that that particular risk liability, you have to split it. You have to do what? To split it between non-current and also what? Current. Non-current and current. Non-current and what? And current. So therefore, generally that is how the risk is accounted for by the person who is called the lessee, by the person who is called the lessee, by the person who is called the lessee, the person who is called the lessee. That basically how he recognizes what? He actually accounts for the risk. He accounts for what? For the risk. 𝗙𝗏, can you pardon on the risk liability calculations? Liability calculation, which one now? which lease liability